I want to welcome you to the first installment in our course in real estate investment analysis. In the future sessions, we're going to go into a fair amount of depth and detail as we learn how to analyze a potential income property investment, learn how to evaluate it, how to decide if it looks like it's potentially a good investment or perhaps not so good, how to understand the metrics, calculating the metrics, interpreting them, how to understand partnerships and financing, and hopefully a lot of other useful and interesting topics. But I thought for this first session, it might be a good idea to begin truly at the beginning and to stop and think for a minute about what really is an investment and who is an investor. So I would propose a definition of investment that it's the commitment of money, time, and effort for the purpose of making a profit. Now, I don't suppose it comes as a surprise to anybody that we talk about making a profit right off the bat. For some investors, however, especially new investors, novices, the part about a commitment of money, time, and effort somehow seems to get lost in the glow. But I would submit to you that investing is essentially a business. And like any business, you do have to make those other commitments. You've got to expect to spend time and effort, to put your own money into it. Success is not going to chase you. You're going to have to chase it. And so these other considerations are really part of the reality of what being an investor is all about. So now, what are some of the characteristics and issues that are usually surrounding the investment process? Well, let's start with that commitment of money that I mentioned just a moment ago. Let's call it commitment of capital. I'm sure you've met or heard of people who have made money without a commitment of capital. They perhaps have gone and done some house flipping where they get 100% financing, sell the thing for a profit in a short amount of time, and go home from the closing with more than they started off with. And that's fine. Any way that you can make money honestly and ethically is a good thing. But I don't think I would call that investing. That might be more speculation, or perhaps there's some other better term for it. But investing really means that you've got something committed, something at risk, that you've got some skin in the game. And I don't think we're just playing with words here, because in the future, when you're looking at multiple properties perhaps, or when you're comparing different opportunities for the use of your investment money, you're going to want to have some way of distinguishing the potential success or the actual success of one from another. What is the return likely to be on this property versus that property? What's the return likely to be on this property versus a non-real estate investment? And the only way we can really measure those returns is if we measure them against something that we have in fact invested, something that we have committed. And so commitment of capital is an essential part, I think, of the investing process. Another part that is inescapable is risk. I think just about every investment involves risk of some sort. Could be a little bit of risk, could be a lot of risk. We can go from one extreme, such as, perhaps a treasury bill, where if the U.S. government doesn't go bankrupt, you can pretty well assume that you're going to get paid. Or you can go to the other extreme. Take, for example, a defunct building that you're going to repurpose, revitalize, and turn into the crown jewel of its market, a place where everybody's going to want to rent, everybody's going to want to be. Well, with that kind of an investment, a lot of risk is present, and so you will probably want to expect a related characteristic to be attached to this. And that characteristic is return. Risk and return are inextricably linked to each other. If you have an investment with low risk, you can expect a low return. Think about that T-bill again. If you have an investment with high risk, you can hope, not count on, but hope for a high return. Certainly you will expect a high return. Certainly you will not get involved unless there is the potential for a substantial return with a risky investment. So return and risk are essentially two sides of the same coin. Now there's yet another consideration that we want to keep in mind with any kind of investing, and that's liquidity. With stocks, mutual funds, those type of equity investments, liquidity is pretty good. If I buy a stock today, for example, and I wake up tomorrow morning and say, that was not a good idea, I can usually sell it very quickly. The same is not necessarily true of real estate. I can buy property today, but if I want to sell it tomorrow, tomorrow may be a little fast in terms of my expectations. Sometimes I can get lucky and I can sell quickly. Other times it may take a longer amount of time. If that doesn't sound like happy news, you do want to keep in mind that one of the other characteristics of real estate in particular is that values don't fluctuate for the most part rapidly. Unlike a stock, unlike a mutual fund, which can move a substantial amount up or down in just a single day. Think about day traders, perhaps in a single minute. Real estate generally will move rather slowly, so the lack of liquidity doesn't have quite as onerous an impact on us as it might if we were talking about a stock. Okay, now there are some considerations that we might want to take into account when thinking about real estate in particular. And one of these is the ongoing commitment of time and effort. You'll recall that was one of the first things I mentioned as part of our definition. If you're investing in stocks or in mutual funds, there probably isn't a lot of time and effort other than the initial screening that you might do to select a stock investment, and then occasionally keeping on top of the success or failures of the company that you've invested in or the companies that are under the mutual funds umbrella. But with real estate, the ongoing commitment of time and effort is typically somewhat greater. Tenants need to be found, leases need to be signed, maintenance needs to be performed, improvements need to be undertaken. There are activities involved in property management, which, whether you do them yourselves or you outsource them to a professional, will still involve your ongoing supervision, your ongoing attention. Yet one more aspect of investing in real estate that we need to consider is leverage. Now, once again, this could be applied to investing in equities. People do buy stocks on margin, but with real estate, it is more typical than not to use leverage, to use financing. Now, there are people who buy property for all cash, and that's fine. But there are also a substantial number, probably the majority, who buy with mortgage financing. And the interesting part about that, of course, is that it means that we can acquire an asset, usually that is valued many more times than the amount of equity, the amount of capital we have at our disposal. If we're going to buy a property with 80% financing, then that means that we're buying a property that is worth 5 times as much as the equity we have available to invest. Now, what about the investor? What characteristics do we need to consider when thinking about the investor profile? Well, I would submit to you that there probably are at least 3 that we want to be aware of. And the first of these is motivation. Why are you investing? What's motivating you to do this? I mean, it's somewhat simplistic to say, because I want to make money. Of course, everybody wants to make money. But what is your specific motivation? Are you looking for short-term cash flow? A few extra dollars every month coming from this income property? Or are you thinking perhaps long-term? How do I pay for my kids' college education? How do I pay for my retirement some number of years down the road? Looking at the long-term creation of wealth. So you need to understand what your motivation is as an investor. You have to understand what your risk tolerance is also. You may be very comfortable undertaking a risky investment with the hope of a high reward and not particularly fazed by the possibility of losing the amount of equity that you put into it. Or, on the other hand, you may just not be comfortable in that kind of a situation. Very often, age plays a factor in this sort of risk tolerance decision as well. If you go to a financial advisor for your stock portfolio, one of the things that advisor almost certainly will do is to say, well, you're young, you can afford to take some risks because you have a long time to make up for any losses that you may incur. But if you're near retirement, perhaps you don't want to be quite so adventurous. You may be more into bonds than stocks at that point. And the same is true of real estate. You may want to get involved in projects that have a high risk, high return profile when you're younger. You may want to get involved in projects that have lower risk, low return type of profile when you're closer to retirement. And that gets, of course, to what I think is the third of the investor profile manifestations, which is, what is your expectation of return? What's okay with you in terms of how much of a return you're going to earn on your real estate investment? And that's a very personal decision. There's no right answer. There's no universal rule of thumb that anyone can really give you for this. Your expectation of return has a lot to do with what can you do with the money you have available to invest. If you own a business, for example, you may be thinking, well, which will give me a better return? Investing my capital in growing my business or investing my capital in buying real estate? On the other hand, if your sole source of income is from a paycheck, from a job, you may say to yourself, well, I'm not going to be able to invest my capital, my savings, if you will, in anything related to my job perhaps, so I want to invest it in something that will grow over time. And real estate typically is a very good choice for that. So just to recap, we've talked a little bit today about what is an investment. It's a commitment of capital, time, and effort. And who is an investor? Now we need to jump with both feet into learning about how to analyze potential income property investments and to make the most of them.